Good morning.
Good morning. Yeah, get ready to my Zoom.
You and Joyce want some pizza?
So how's everybody doing today? I hope everybody's having a good day.
Most excellent.
Good.
And yourself?
I'm awake, if that counts for anything.
That's good.
Multitasking as always.
I was just reading PS 3877 over in the other room.
Yeah. What's that on?
Well, yeah, you know. What's that?
Remind me, what's that one on?
That's the firm handle, firm book.
Firm registry mail book, yeah.
Yep. Yeah, you know, first steps.
Have you done any research on the dispatch registry manual? See, that's the opposite side. You've got a firm mailing registry, which shows that something has entered into the mails, and you have a manifold dispatch book, which shows that a private article was dispatched through the mails.
Yeah, it's that firm. It's interesting how that works with the manifold dispatch, how they work together, and how they're used against us. Really.
Yep.
Don't you think?
Oh, most definitely. It's not really that they're used against us. It's just that they're used and we're kept in ignorance of their use. So
yeah,
that's why
more
I say
accurate way.
We have to start learning about this stuff and then enforcing that education by teaching others.
Well, I'm working on doing this step by step, Keith. Like the other aspects that I appreciate what you're doing because your expertise with the treaties and the contracts and being able to ratify them. The applicable steps that I'm taking, because one of my persons is collecting all their numbers. I don't know if I told you that. Did I tell you that?
Oh yeah, well, you've got an extensive list of different kinds of numbers. So, and I said this before. You mentioned it some other time about the 6-digit number, and I mentioned we want to get together and so I can start coordinating those numbers. because like the 9-digit number is
Yeah.
different than the 10-digit number, the 11-digit number, and they're all different levels of numbers.
I keep finding some that are like, this one's 20 numbers long. And so really at this point, because my person is, kind of a bastard, but I know how to operate that person so that I'm not liable for the actions, that I figure, I think that our Father who's art in heaven and wisdom doesn't want us to run necessarily completely away. It's to know how to navigate. And so I'm willing to kind of put my neck out there a little bit to learn this part. So
Yep.
once I get a little further along, like if you and I want to get together, I can share what I've done, and then whenever you decide about sharing more broadly,
All right, cool.
I yield.
We'll do that. Awesome. Okay, so last night we spoke about the banker's acceptance again, along with those other two details about the NIACs and how it works with the United States and the corporation and all that. And basically what it is again, we're establishing our line item veto through anything that's put out there as a public offer. And that's all it is. It really is just a simple contract. And that simple contract is denoted as a banker's acceptance in a lot of different forms: a check, a coupon, all kinds of things, like we discussed, international bill exchange, promissory note. They're all basically synonymous with a banker's acceptance done on international trade transactions. And so what we're doing is we're operating on the international trade side, and we're giving a trade note. Just like a promissory note, we're gonna make it a trade note. We're gonna qualify the phrases on it for a trade transaction and not a fiat currency in commercial paper as a commercial transaction. A buyer with an importing business. Again, it's the importing business. This is the United States, and they're the ones that are making these regulations. So they're telling you they're the buyer with an importing business can issue a banker's acceptance. No, anybody can issue a banker's acceptance, and the difference is it's how it's described: an irrevocable letter of credit. Same damn thing. We're just going to correct the verbiage on it and qualify the phrases so that it operates the same way. As we saw, a banker's acceptance operates the same way as a certified check. Well, I guarantee you, irrevocable letter of credit operates the same way as a certified check. All right. So what they're telling you is, in different languages, it all means the same thing. And it's got, with a date after shipment is due to be delivered. So again, just like a promissory note, it's got dates and shipment dues and all of that. It's got the buyer and the seller, who's exchanging what. And the seller with an exporting business will have the payment instrument in hand before finalizing the shipment. So when we have that instrument, that certificate of live birth, and we want to give it back to that, in other words, we want to export it from our jurisdiction and allow them to import it again, that's a reversion. That's a reconveyance. We've got to give them a notice of our interest, notice of our priority, absolute title, this and that. However you need to verbalize that before finalizing the assignment back to them. The person who is paid with a banker's acceptance, and they're telling you right there, that's how you pay things, is with a banker's acceptance, with a certified check, with a negotiable instrument. That is payment. Is paid with a banker's acceptance, which is known as a negotiable instrument, known as legal tender. And they may hold on to it until its maturity date. And it tells you right there, a banker's acceptance now becomes a bond on the market. It's already on the market. And it now has a maturity date. You have to give it a maturity date. When you give it a maturity date, It's going to be like 90 days. You got 90 days to make this sucker happen. Okay. And in order to receive its full value, or can sell it immediately at a discount to face value. And that's what I was talking about. We're going to sell it back to them at a discount so that they've got a little money in their pocket so they can turn around and sell it or do a credit default swap. However they want to do it. I don't care. I'm out of it. Unlike a regular check, a banker's acceptance relies on the creditworthiness of the banking institution. And this is why I say it's an irrevocable letter of credit correcting the status that we have as the actual creditor. Bankers' acceptance as investments, and this is what they do on their side. We're not doing it as an investment. We're doing it as a reversion, like I just stated. We're going to revert everything from probate back to the live estate. And that's what we're establishing. We're establishing the live estate. And just like their strategy is similar to that used in trading, zero coupon bonds, we're going to use a zero balance credit drawdown account. Everything is going to draw down off of a credit account, not add to it. You can never add to the credits. It's just going to be drawn down from the credits that already exist and are acknowledged to exist. And then those could get zeroed out because everything's a donation. And so when the taxes get paid, it gets zeroed out. Whether you do that every quarter or every year, or make it assessed in your irrevocable letter of credit that it's to be done automatically by them. You don't file those papers. You can make it part of that contract. Fiduciary assignment is to them to make sure all of their forms and the transactions and processes resulting from those forms are done accurately. And the banker's acceptance is sold below face value at a discount determined by length of time before the maturity. So if I say you got 90 days to accept this value, they got 90 days. They should accept it right away with that value that they can reinvest into that market, because that's the only way they're going to make any money. Because if they let this expire in that 30 days, it's done. It done matured. Now I can call it back. Now I can call it back for not accepting it. That's dishonor. As long as that instrument is accurate, they are supposed to accept it. That's what bankers' acceptances are all about. Bankers' acceptances are considered to be relatively safe investments. Again, we're not dealing with investments. That's why we have to be very sure that we comprehend all the language and we correct it all. We are the only ones that can perfect it. Otherwise, it continues to float in their markets as a negotiable instrument, never being perfected. One of the key advantages of bankers' acceptances is it backed by a financial institution protected against default. This is the importance of that irrevocable letter of credit with the silver surety bond. You got to have your assets separated. You let them know you have assets. And it doesn't necessarily even have to be silver. It's just a set of assets, things of substance that have value. It could be antique furniture appraised in their system to have such and such a value, which can be verted to a gold market. All it is conversion of the weights and measures throughout the different value systems. So as long as you have something of value, again, 18 USC 8, obligations and other securities of the United States, and they use in very plain language in there, it says stamps or other representatives of value. That's all we're doing is putting forth a representative of value. And that's our asset. Meanwhile, buyers are afforded the ability to make purchases in a timely manner and not worry about having to make payments in advance. Again, we're not making advance payments because we're going to establish a advanced credit account. So we're not going to be buying and selling anything because, like I said, everything is going to be a donation. Now, the key risk is the financial institution will have to make good on the promised payment. Well, I make good by making sure that everything is a donation. I don't ever buy or sell everything. It always goes through the organization and it gets donated through my purchase. I am the holder of the instrument for the entity. That means it doesn't collapse. The entity is a beneficiary. I'm the trustee. I hold the title. And as trustee, I use it to make purchases as donations, as the organization says. This is the key risk for the bank. To help hedge against this, the bank may require the buyer to post collateral. Again, we're not buying and selling anything, and we are the ones posting collateral, but the collateral is our verbiage, is our irrevocable letter of credit. They have no right to access the actual assets. That has to be contested first. There first has to come a dispute. When we're correcting the record, they can't come back at us and say, well, you don't have assets. We have assets simply because we say so. Until they correct their record, they can't assert any authority over anything. Pros, it provides the seller assurance against default. Again, we are not selling and buying. This is going to be a banker's acceptance converted to a trade acceptance, basically in simple form. It's still contract. You're just going to learn how to overwrite, line item veto, and all that. The bank may require the buyer to post collateral before issuing the banker's acceptance. If we're the one that's issuing the banker's acceptance, what we're doing is issuing it for the return of collateral. And the only collateral we can get is a credit, because that's all they've taken. They didn't take your labor. They didn't take your time. They've taken the credit. So we want return of everything that which is not gold. In other words, the credit. The buyer doesn't have to prepay or pay in advance for the goods. The buyer is the one that is importing it. This is the basic principle of import-export law. It is the exporter that has to pay the taxes. Then once the taxes are paid, the importer institutes insurance on the product. That's all it is, taxes and insurance. It provides the ability to purchase and sell goods in a timely manner. This is why if it's abandoned for 30 days on that store shelf, it is abandoned. They have not accomplished their goal of buying and selling that product. Instead, it is now sat on a storage shelf for 30 days and nobody has made a proper and valid claim. It says the buyer may default, forcing the financial institution to make the payment. The buyer may default. Again, we're not the buyer, but we can, as the buyer, in the same capacity as a buyer, default because we are in fact the end user. And the product, as I said, is already paid for. The only thing that we're dealing with on the internal level is the taxes and insurance and the licensing fees and all this. The product itself was already paid for. Full faith and credit. It has a relatively low cost compared to the hedge. The hedge or benefit provided. The benefit provided is a privilege within their system. That privilege is the ability to take advantage of your fellow man. I don't call that a privilege. I call that an abuse of a right. How does banker's acceptance work? For banker's acceptance, the importer will seek to make a purchase from the exporter. Guess what he's going to purchase? He's going to purchase the correction of the record so his ass doesn't end up in prison. The exporter wants assurance of payment, full faith and credit. That's it. I don't want any products, anything. The exporter wants assurance of payment. But the importer also wants assurance that the seller can deliver. The seller, again, like I said, I'm not going to sell or import anything. I'm not the exporter. I'm going to issue an instrument, an irrevocable letter of credit. And they have to accept it. because it's based on their system being correct. Banker's acceptance is a form of payment backed by a bank that eliminates transaction-related risk for the importer and exporter. Does that sound like a peace agreement? I will no longer hold you liable so long as you clear the record and show that I am not liable to begin with. That's what we're talking about, liabilities. They have placed us as the liable party, and we are in fact not. And this is proven by the numbers. Is a banker's acceptance a money market instrument? It can be. It can be. It doesn't have to be. A banker's acceptance are money market instruments and, like most money markets, are relatively safe and liquid. Comprehend this and let them know, hey, I'm relieving you of your liability. All you have to do is accept this and make the payment. In making the payment, you also get a nice chunk to invest for your bank, particularly when the paying bank enjoys a strong credit rating. Strong credit rating. Well, when it comes to that strong credit rating, we're removing the probate credit rating of the decedent because it hasn't been in fact operated correctly, and therefore that credit rating can't be wrong or can't be correct. That's what we're correcting. Our credit rating is stronger than what it reflects because it shouldn't be there. The credit is being shown as that of the person. It doesn't belong to the person. It belongs to me and is extended to any person I wish it to be extended to according to my authority. What is a banker's acceptance rate? Bankers' acceptances are assumed to be safe investments as they are backed by the bank, which means they often trade at a discount to face value. I want to issue a $250 million bond. I want 125 million of it. I'll give the bank 125 million. How's that for your rate? How's that for equity? How's that for equality? I get 150 million, you get 150 million. Ain't no way in hell I will spend 150 million in my lifetime on credits. However, I will be sure to show how everybody else can get the same 150 million in credits in their own account. And they too will have a damn hard time spending 150 million in credits. So therefore, you got 150 million in credits. You can draw down $1 million every year, and it just zero balances out at the end of the year because $1 million is done in donations. And guess what? That $1 million done in donations is done on behalf of the United States for a contribution and not a debt. It actually helps redeem the debt of the United States at the same time you are operating in the capacity of redeeming the land. Pure and simple. By reason and logic, they cannot refuse a proper acceptance. The banker's acceptance rate is the market rate at which these instruments trade. So I guarantee you, it doesn't matter what rate is going to apply if you give them 125 million. Oh, great. These transactions going on in the court for $125 traffic citation, they hit maybe $1 million. You give them 125 million in proper banker's acceptance, and I guarantee you that bank is going to be happy, joy. All their employees are going to get a banking bonus at Christmas time, and the bank is going to sell that note lickety goddamn split. It's a return an investor would receive if they purchased today and held until the payment date. What is the difference between banker's acceptance and commercial paper? Commercial paper is a promissory note that pays a fixed rate. A fixed rate. And this is exactly what we are doing. We are fixing all of the rates. We are fixing the actual original value. It's unsecured and can be for a few days or years. We're going to secure that puppy. We're going to take a few days or a few years constructing whatever we need to construct in this commercial paper, letting them know that we promise in a note that we have been redeemed and he has called us by name and we are his. And that will fix everything from now on. Because as long as you know your capacity and how to qualify that signature, you won't ever sign another document again. You'll have somebody else do it. Commercial paper is generally used to cover short-term obligations, such as the cost for a new project. The new project is the developing family. We are merging and reorganizing with the confirmed plan, a new project under a new name, or short-term receivables. BAs are also short-term promissory notes. They also, although they have the unconditional guarantee of a bank and are often used for trade. So like I said, it's a banker's acceptance, but it's the reversion for a trade acceptance. Okay? Promissory note that is going to take a few days or years. And what it is, it's a few days or years to transition. So I say it's a special deposit into a transitional credit account so that you can develop as your own family, your own assets. Your own assets. The bottom line, from an investment perspective, bankers' acceptance are relatively safe investments, being money market investments and in line with T-bills. What's a T-bill? That's their generally accepted accounting practices and principles. From a risk-return perspective, we don't need a return. Everything we give freely. Again, we are not importers and exporters. We're not buyers and sellers. Help boost trade by reducing transaction-related risks. If there are less transaction-related risks, then you need less insurance. If you're not risking anything in your transactions by using the proper terms, qualifying phrases in your commercial paper, remember, man is bound by his words. So make sure your commercial paper with that promise states the true and correct promise. I cannot go forth in a commercial name anymore. I have to go in the spirit of the Father, the Son, and the Holy Spirit. It has to be a tribunal from here on out. Okay, now that we've gone through that, we're going to go back to Banker's Acceptance 101. Let me pull it up here. Obtaining a banker's acceptance. Remember, I spoke about the letter of credit, irrevocable letter of credit. Banker's acceptances can be created as letters of credit. Documentary drafts and other financial transactions. If you are trying to obtain an acceptance, approach a bank with which you have a good working relationship. I approached my companion's bank and let them know that I am my companion's trustee above and beyond all else other presumed, assumed, and implied trustee capacities held by anybody, whether they be bankers, lawyers, doctors, judges, politicians, anybody. And she will write a documentary draft stating so. You need to be able to prove or offer collateral against your ability to repay the bank at a future date. Collateral. What is collateral? The term collateral refers to an asset. What is an asset? My word is my bond. That paper is the asset itself in their system. Pure and simple. You do not have to provide the asset. The paper provides for the clarity that if at some point in time you acquire that asset and there is a breach by your actions and your intent, both, it has to be clear action and clear intent. Then and only then can they come after your assets, and only for pecuniary reversion. In our letter of credit, that's exactly what we're doing, is reverting everything to a transitional credit so we can reestablish the assets that we never actually attained. Everything's been done under military acquisition. That a lender accepts as security for a loan. Once we have assets and clarify that we are the asset holder, who is the only one that can be known as the lender? The one that has the assets to lend. Pure and simple. The collateral acts as a form of protection for the lender. If you have collateral, do you need further insurance to protect? No. It's already protected by the very asset. Thus, the entire system requiring everybody to have insurance proves that they have no assets. Proves that there is no assurance, which is what the assets are. Assets are the assurance, saying that you don't need insurance because it's right here. Collateral against your ability to repay the bank at a future date. If we no longer have an agreement with the bank to repay them because we've nullified the fact that they are not the borrower, then there is no ability to repay because there is nothing to repay. Many, but not all banks offer acceptances. If they can offer an acceptance, can you offer the same thing? Most certainly. It's a commercial paper. That's all it is, commercial paper. Commercial paper is known as negotiable instrument, known as legal tender. A banker's acceptance operates much like a short-term fixed rate loan. You go through a credit check and possibly additional underwriting processes. We're going to put them in check with the fact that we are the creditor, and their underwriting is violating that extension of credit. And therefore, we line item veto their underwriting and override it, taking away the insurance powers, clarifying they have none, because the insurance itself clarifies they have no assets. Otherwise, they wouldn't need insurance to do their transactions. Third party. You are also charged a percentage of the total acceptance to purchase it. These are elements that you write into it. Like I said, when we're doing our line item vetoing, when we do that bank, 125 million for me, 125 million for you. That should cover all of your charges, fees, excesses, percentages, and everything. Let's be fair about it. I don't think anybody would argue that. That is the definition of equality. All parts are equal. You get half, I get half. You're the party, I'm the other party. Here's your half, here's my half. Done. If you are looking to purchase a banker's acceptance for a short-term investment, there is a relatively liquid secondary market for partially aged bankers' acceptances. This is telling us that you can buy them yourself. Guess what? They are normally sold at prices near or below benchmark short-term interest rates, but you can also get one from your Bureau of Statistics or Bureau of Vital Statistics. Once you've purchased it, you can slap the transfer tax on there and make your banker's acceptance. Capital transfer tax. You're now going to revert the capital of which is known as assets by reverting it to a transitional credit account, allowing you to establish actual substantive assets known as real property. To understand bankers' acceptances as an investment, again, we're not going to invest it. We're only interested in the investment part on the concept that we need to make sure they get all they want. Make them pleased. Please them. You do it for 250,000, and actually it shouldn't be done for, as we discussed, it should be done for half thousands. It should be increments of 100,000. So if you do 200,000, give them 100,000. If you do $1 million, give them $500,000. Here's one fairly typical example. We're getting ready to run out of time, so I'm going to be done here and then I'll put it to the floor. An American company, Clear Signal Electronics, decides to purchase 100 televisions from Desner Trading, a German exporter. After completing a trade agreement, Clear Signal approaches its bank for a letter of credit. This letter of credit is so they can turn around and sell that which they are now going to store. They've already performed the trade agreement, and now they're an importer, exporter, buyer, seller, whatever. We're going straight to the American company. We're not going to go to the dealership or anything like that. We're going to start learning how to make our trade acceptances. Okay, we've only got a couple minutes here. Who's open to just doing another Zoom for question session?
I am.
I'm in.
Awesome, because it's Friday night and I ain't got nothing else to do because I'm nothing but a great learner and explorer. Don't ever let anybody call you a loser on a Friday night doing this. This is mankind's most powerful potential is knowledge and education. Thank you for joining me on this Friday night, folks. So when we get done here, we'll go ahead and I'll open it back up again. So you just
So
go.
let me just throw some questions at you, okay? So this is one of my questions, or would it be or limit? How will we get the bank? Okay, we draft these documents, right? We got them ready to go. Now, let's say the bank say, well, we need to run a credit score or a credit check.
I'm sorry. That's not part of the issue. That's what we're clarifying on the record is we're correcting that credit score. That is of the decedent. We are removing everything from probate. That includes removing the credit score.
Okay. I got a philosophy on how I'm gonna do it for us with the hereditament and all of that, removing it out of probate and coming into that the heir is worth his weight in gold. This is a bond. This could be used or whatever. How I'm gonna dialogue with the hereditament, showing evidence like of the heirship and how the assets can be used for that. But I'm trying to, when I'm approaching these entities,